Well, hello and welcome, everyone. On behalf of Questrade, I'm excited to have you joining us for today's webinar, An Introduction to Index Investing, brought to you by John Robertson, author of The Value is Simple and host of the Because Money podcast, as well as Anna Music from Passiv. Just a couple of quick items before we begin. First, everyone who signed up for the webinar will be emailed a copy of the recording later this week, so please watch out for that in your inbox. And second, we will save a few minutes at the end of the webinar for Q&A. So if you have any questions, feel free to submit them in the chat window, and we'll get to them at the end. With that out of the way, I want to pass it over to John, who will get us started. Take it away, John.
Thank you. So, as Jeff mentioned, I'm the author of The Value is Simple. I've also put together an online course called Practical Index Investing for Canadians that walks people through the step-by-step method of how to get going. And then is from Passiv, which is a web app that lets you helps you follow a passive investing strategy by automating some of those tasks that we're going to be talking about, and she's going to follow on after I talk. Some quick disclaimers: neither of us are licensed to sell any investment product, and this presentation is general financial literacy. We're not here to try to sell you any particular product or particular service, although it would be great if you did use some of our services to help yourself invest. I'm an independent educator, and my views and opinions are not necessarily those of Questrade. So becoming a more successful investor involves a number of elements to sort of put that recipe together. You need to understand the investing basics, why you're investing. You want your money to grow, of course. A plan to help support your investments and motivate why you're investing and how you're investing. You need to then actually save some money so that you have money available to invest, which means you've got a budget and spend less than you earn. Then you're going to design a portfolio of investments and then actually go and purchase those investments and maintain your portfolio over time. So as you're purchasing more investments and they change in value, getting back to your design portfolio, you're going to have to deal with some taxes and tax shelters. So whether you're going to use your TFSA or your RRSP, which one is going to be better for your situation? And if you have to invest in a non-registered account, how are you going to track and report those taxes? And of course, there's behavioral issues. So how are you going to stick to your investing plan for the long term? It's great to come up with a plan that seems, very aggressive at the beginning, but then are you going to be able to stick through it through your first market crash? And that's going to be important to becoming more successful over the long term. This is all a very big syllabus, and we're not going to be able to cover it in a half hour today. So we're going to focus on a few things. If you want more, of course, that's what my book is talking about. But today we're going to talk a little bit about active versus passive investing and the importance of fees, as well as a very quick little mention about how to design a portfolio and then how to maintain it, and in particular how passive can help you with that maintenance step. So very, very high level, very quick introduction. Investments are where you want to use your money to help grow it and have more money in the future. And there's different ways of doing that. And in particular, we're going to be talking about stocks, which is where you're owning a portion of a business. And this is what we consider like our risky stuff or more volatile. So we're hoping that it's going to grow and provide us with greater value over the long term, but that's never guaranteed. And it is definitely going to be more volatile along the way. And then other methods include having a savings account or a GIC, guaranteed investment certificate, where you're earning interest. And similarly is something called bonds, which is where you're loaning some of your money to a government or a corporation, and they're going to pay that money back along with some interest. And then you can trade those bonds. So that loan that you're making, you can trade with other investors so that you're not necessarily locked in for the full term of the loan. Bonds are generally less volatile than stocks, so then you can pair bonds and stocks together to make a portfolio where the risk of the portfolio kind of matches your own risk tolerance. But because bonds are generally less volatile, they're also generally going to have a lower expected return over the long term than those stocks would. And of course, you don't have to buy all of these individually. You don't have to buy individual stocks or individual portions of companies and individual loan agreements or bonds. You can have mutual funds, or I'll just call funds in general, which are collections of stocks and bonds. That makes it a lot easier to become an investor. So you don't have to worry about researching all these individual companies, tracking each of these individual purchases. You can just buy a couple of mutual funds that then gives you exposure to hundreds or even thousands of companies or individual bonds. And of course, there's lots and lots of stocks and bonds out there, and lots of funds of stocks and bonds out there. And indexes were created to help answer the questions like, how's the market doing today? Or how's the average stock doing? Because if you're looking at the stock market with all these thousands of different stocks trading, and you want to know, like, how did the market do today, and you just want to read a newspaper article about it. It's kind of difficult to do that when some of them might have been up and some of them might have been down, and it's all very sort of company specific. And so the newspapers started creating these averages where they could talk about, how the average stock might have done today by picking a couple of big stocks and basically just averaging their price. And it turns out these indexes were not only really useful for talking about, how's the market doing today, but also as a benchmark for how these funds were performing. If you had a manager who was picking a number of stocks to put into a fund and was selling that to you, was that manager actually able to do any better or worse? Usually you'd be looking for better than that average stock return that they're talking about in the index. And these indices, they're around in a couple of different asset classes. So you can have Canadian bonds, and one particular index that you might have heard of is called the Universe Bond Index, which is a combination of high grade or investment grade companies in Canada, their bonds, as well as some government bonds, and it's a mix of both. You may have heard of the S&P TSX Composite Index. So this is an index of several hundred Canadian companies, mostly large cap companies, as well as some getting into what we call mid cap size companies. And you may have also heard of the S&P TSX 60, which is just the 60 larger companies on the TSX. For US stocks, we've got a number of different indices that you may have heard of. Dow Jones Industrial Index is an important one for historical reasons, but because it only contains 30 companies, it's not one that people are usually talking about in terms of investing in index funds, but it's a good source of data and to talk about because it is so historical. The S&P 500 is perhaps something that you've heard more. That's the Standard & Poor's 500. So it's not actually literally 500 companies. The number varies around 500 depending on what the committee decides goes into that index year to year. But again, it's an index of 500-ish large companies on the US exchanges. And there's also total US market funds, which then contain, instead of just 500, thousands of US companies. And then there's indexes that track international stocks, such as the EFI index or Europe, Australia, and Far East index. And so that's the developed markets overseas. And each of these indexes tracks various groups of stocks, and index funds have been created that will just then invest in those indexes. And of course, you can compare the performance of a mutual fund, whether that's an active mutual fund where someone is trying to pick specific stocks or specific bonds to outperform their index. You can compare the performance of those mutual funds to an appropriate index. So if you're buying a Canadian-based fund, not an index fund, but an active fund where someone is picking particular stocks to put into that fund, you can compare how well they do compared to the S&P TSX Composite Index, for example. And it turns out most funds underperform their index net of fees. And of course, that net of fees is an important disclaimer because in order to provide you with that active selection of stocks and to manage the fund, a lot of mutual funds are going to charge you a fee. And in a lot of cases, that fee can be relatively high. And so that fee being high presents a barrier to you doing well and to being able to outperform the index. And this gives rise to index investing. If you're going to pay high fees just to underperform, then why not just buy the whole index and keep your fees as low as possible? And of course, these fees do really matter. And to show that sort of visually, here's some simulated data based on historical Dow Jones Industrial Average returns. So if you had invested over the course of 35 years in the dotted line with no fees, your growth would be relatively huge there, as you can see on the chart. It was not a straight line. There is volatility involved, and that's what we're talking about with these ups and downs. But as you start to add in fees, because of course, the reason I put it in a dotted line there is because the index is an imaginary construct. You can buy an index fund that tracks the index, but then any index fund is going to have some kind of fee. But you can get those fees pretty low for index funds. So for instance, 0.5% per year is quite manageable. And when we're talking about these fees, we're talking about them in what's called an MER, management expense ratio, and that's expressed as a percentage. And these percentages sound small, but they really add up over time because they compound over time. Every year that you're owning the fund, it's draining away at your potential returns. So in this case, if we have 0.5% return or 0.5% fee, it's going to take a bite out of your returns, but only a small one. Whereas a 2.5% MER which is fairly typical of a lot of mutual funds in Canada. It takes a much bigger potential slice of your returns there. And that really becomes meaningful after the course of a 30-year investment horizon. And so in that case, you can be looking at losing up to like half of your potential returns to fees. So fees really do matter. And of course, fees you can know in advance. So this difference between paying some reasonable level of fee and a much higher fee, you can know in advance what the fees are going to be and control that. Now, there is also going to be volatility. So for instance, going from this part to this part on a single chart, we're talking that's volatility. You can't control that. That's just part of investing, but you can control the difference between the lines by controlling your fees. Of course, there's other reasons for choosing index investing over active investing. One of them is that what we call market dispersion, which is that not all stocks produce average returns. Some are going to be much better than others, but the dispersion in the returns, so how far apart the different returns are, is quite wide in reality. And it turns out that a few big winners really tend to drive the average return up. So if you're missing just a few of those big winners in the stocks, your overall return might be relatively low relative to the index, even if overall you had some decent companies in your fund. And so because you can't afford to miss the winners, you want to just buy everything and then you make sure that you get them. That's part of what makes index investing so successful, in addition to, of course, the lower fees. And of course, outperforming is hard. So that difficulty element drives people towards index investing. It requires research and time with that low probability of actually outperforming. And it's very difficult to find what drives outperformance in advance. So some of those mutual funds and some individual investors picking individual stocks will outperform the index, but it's very difficult to pick which of those funds or which of those investors are going to do that in advance. So some of them will just get lucky, and you won't know whether it's luck or skill in advance when you have to make your decision. And so, of course, go with the better bet, which is index investing. And of course, the reason I really like index investing and recommend it as a strategy for a lot of people, particularly new investors, but even people that are experienced, is that it's simple. There's only a few asset classes you have to get. You cover your broad global diversification with a few index funds, and that's about it. You find whatever fits you best in terms of cost versus convenience, and you don't need to weigh 100 other factors that it might be conflicting at times and require a lot of research. And you can just set it and forget it, which creates a very freeing mindset. So you can't beat the market, so you don't even try. You don't have to invest all that time and energy into researching. You just focus on keeping your costs low, on being widely diversified and following your plan. And then you can sort of leave this whole investing world to something that you only touch on a couple times a year, and then go and have another much more fun hobby to spend your time on. And of course, similarly, if you accept that you can't time the market, and as part of index investing, you're going to accept that truism, that common statement, then you don't try to time the market. You just invest regularly and you don't worry about it. Okay, so how do we construct a basic portfolio? Well, we're going to have to combine some of that less volatile stuff, that fixed income, your bonds or your GICs, with something that's going to provide you with that long-term but riskier growth, your equities. And you want to diversify everything globally as well as between your stocks and your bonds. So first you need to figure out what your risk tolerance is. And this can involve creating a whole financial plan to really do it well. And so you're going to have a plan that's going to understand your risk tolerance. What's your willingness to take on risk? What's your capacity for loss? What are your backup plans if you do encounter a market correction or crash and your investments are worth less? And that can be complicated, even though essentially all you're trying to boil it down to is like one number, which is how much to put into bonds. And to give you a rule of thumb to start from, again, this is not going to be perfect for everyone, but at least gives you a starting place. I like to take my age and subtract 10, and that's how much I'm going to put into that, quote unquote, safer stuff or less volatile stuff. So if I'm 39, I'm going to subtract 10, and that means I'm going to put 29% of my portfolio into my fixed income, and the rest I'm going to invest into my equities for my long-term growth. Now, my equities, I want to diversify globally. I want some to be in Canadian equities, I want some to be in US equities, and I want some to be in rest of the world equities. So that EV index, in my case, is what I'm going to be tracking. Now, there isn't a hard and fast rule for exactly how to split this up. So I like to split it roughly equally. That makes it very simple and gets me close enough, and then I don't really have to worry about it. If you want, you can dive into the research and try to figure out exactly, whether you want 20% versus 33% in one category or another. And I'm not going to fight anyone over, what the optimal is, because it is very, very difficult to pick optimal allocations here. Just don't completely neglect one of these important elements of global diversification. You don't want to completely ignore US equities, for example. And then each of these is typically a fund that you can buy. A bond fund, a Canadian equity fund, a US equity fund, a rest of world fund. That's 4 funds that you have to buy, and then that's all you need to build your portfolio. And then it can get even simpler than that, because there are some combination funds out there that mean that you don't even have to buy like separate US and rest of world equities. You might be able to buy a single fund that combines those. And there's even all-in-one funds now where you can find one that has your bonds, Canadian equities, US equities, rest of world equities, all in a single fund. And then you only need to go and buy a single ETF or exchange traded fund to meet your portfolio needs. So when I'm designing my portfolio, I'm going to create a little table like this to help myself structure it. And I'm going to write this table down somewhere where I can find it again later, because I'm going to want to maintain my portfolio at whatever I set this up. So I've got my basic asset classes that I've decided to include in my portfolio. Again, you're welcome to change this and update it for your own needs if you want to slice and dice, for instance. Instead of just going with the broad market for each region of the world, you can slice and dice by various sectors if you want, like healthcare and consumer supplies and materials and all these other sectors of the economy that are included in those overall ones. I don't necessarily recommend that myself. It starts to get too complicated and the fees can start to creep up higher, but some people prefer to take that approach. So I just thought I'd quickly mention that you don't have to do it with just 4. But whatever you do, you're going to want to write it down for your future reference so that you can come back to what your plan is. You're going to pick a specific product, so like an exchange traded fund that's going to meet each of those components. You're going to take the weighting that you've assigned to it. So for instance, if I'm putting 29% of my portfolio into my bond fund, I'm going to put 29% in there. And then I need to convert that percentage weighting into an amount in dollars and then a number of units that I'm going to buy. So if I have $10,000 to invest, and I'll put the appropriate number of dollars for each of those components. And then each of those, if I'm using exchange traded funds, are going to be trading at a certain price. And I need to do some division to find how many units I'm going to buy based on the number of dollars that I've assigned to each of those components. And of course, this example here is just an example. Remember to come up with your own plan and your own portfolio construction based on your own risk tolerance. So once I've got that plan in place, I need to go ahead and make some purchases. So first I need to move some money. So I need to get it from my checking account where I've made money for my job or whatever and have money and I'm ready to buy, and transfer it over to my Questrade account. And I want to automate any of these steps wherever possible, including that transfer step. So if I want to save money monthly into my long-term savings, I can set up an automatic bill payment from my checking account to go over to my Questrade account. So I've got the money showing up there on a regular basis, ready to invest and support my plan. Then I'm going to purchase whatever investment products I need in whichever accounts I have to support that plan. So for instance, if I'm buying them in my TFSA and I'm using ETFs, and as the money arrives each month, I want to go ahead into my TFSA at Questrade and buy those ETFs to support my plan. And of course, I can use tools like Passiv to make sticking to my plan easier, faster, and simpler. So rather than having to go in and make those market orders myself or those limit orders on the stock market myself, I can use Passiv to do like a one-click purchase all these funds for me now. And also, instead of having to remember that on a certain day every month my automatic transfer will come through, or remember that I have to send the money from my checking account, wait a couple days for it to show up to my Questrade account, and then log back in to actually make the purchases, I can get an email notification from Passiv that the money is actually there. And of course, over time, my portfolio is going to drift. So different parts are going to have different returns. So for instance, if a stock market is doing very well, my stock components might be increasing in value faster than my bond component. And in that case, my allocations are going to drift. I'm going to have more money in the stock component than the bond component than when I originally set up my plan. And that's going to start now drifting from what I said my risk tolerance was. So I want to rebalance back to what my original plan was and to maintain that same portfolio according to what I said my risk tolerance was. I don't want my portfolio to continue to get more and more concentrated in stocks as stocks are doing well, or if stocks are in the middle of crashing, I don't want my portfolio to become more and more conservative. I want to continue to maintain that balance and not try to outsmart the market. So I want to check about once a year or so to see if I need to rebalance. And there's no optimum frequency. If you check even every 2 years, you're still going to be maintaining reasonable limits on your risk tolerance. If you check daily, you're going to find that even small moves are going to create fractions of a percentage difference in your allocations. And so it starts to get kind of silly to rebalance too frequently. But there isn't an optimum that I can say. I mean, once a year works pretty well because it's easy to set up calendar reminders that occur once a year, and that gives enough time for your portfolio to perhaps be out of whack enough that it makes rebalancing worth it without spending too much time and too many transaction fees worrying about it. So how to rebalance? Well, you calculate what your portfolio should be, just like we did when we first put the money in, and then you make trades, whether you're buying with just new cash that you're contributing, or if you have to sell something that's higher to buy something that's lower, to bring your portfolio back to that target. And again, the passive folks are going to talk about how passive can help you automate your rebalancing with that tool. And with that, I'm going to hand it over to Anna.
Thanks very much for that, John. And thank you for everyone who's joining us today. My name is Anna and I'm from Passiv, and I'll show you how you can put that index investing strategy on autopilot by using Passiv. So first of all, Passiv is a web app that helps you follow a passive investing strategy, and it helps you keep your portfolio balanced. Passiv is for any investors who prefer to manage their own portfolio, but they still want to automate the tedious parts of portfolio management. Passiv can help you save time because you no longer need to build and maintain spreadsheets, and Passiv will automatically calculate those required trades for you, so you don't have to do as much math. And Passiv will also make trades for you with one click, and it makes managing your whole family's portfolio really easy because you can see them all on one dashboard. Passiv also helps you save money by making it easy to manage your own portfolio so you don't have to pay somebody else to do it for you. With Passiv, you can build a balanced portfolio, allocate cash, or rebalance with a single click, and get notified when those new deposits hit your account. So whether that's a transfer from somewhere else, a deposit, or dividends, you'll get an email notifying you that the money's there and you can go ahead and make that one-click trade. And Passiv works by communicating with your Questrade account through Questrade's own API. And this means that Passiv never has access to your Questrade login credentials. And instead, you're able to log in through the secure API, and then Passiv will be able to make these trades for you. Passiv is an official Questrade partner, and using Passiv does not void Questrade's terms of service. And that's enough about what Passiv does. And now I'll show you on the inside a recorded demo of how it looks and all the things you can do within the app. So here's what the Passiv homepage looks like. I'll walk you through how to sign up and what you can do with Passiv. So to get started, click here. Enter your details here, and then when you're done, click register. We'll be asked whether we have a Questrade account already, so go ahead and click yes, and then connect. Notice we've been taken over to Questrade's website now, so go ahead and enter your Questrade login credentials. And this will take us to the authorization page. So here we're asking for Passiv to get access to the Questrade API, or Application Programming Interface. And that's essentially how the two websites talk back and forth to each other. You can also change your device name down here, and then click Allow. It'll take a few moments to get everything synced up. And then now on the dashboard you can see all of your accounts. And then we'll start by setting up this first one. So you'll notice at the top here that you can edit the name of the account, and that it tells you the type of account as well as how much cash you've got in there. Over here you'll notice an accuracy box, and what that does is it tells Passiv how similar your current portfolio is to your target portfolio. And that's basically a measure for you to see whether your portfolio is on track with what you want it to be. Right now we haven't set a target portfolio, and that's why there's no value here. So let's go ahead and set a portfolio up. You can either set your target here by importing your current holdings or by building one manually. We'll assume that you already are pretty happy with what you've got in your portfolio, so go ahead and click Import. And now you can see that the accuracy reads 100% because your current portfolio is exactly your target portfolio. Passiv has already given us a buy suggestion here. So it tells us the current market price and number of units as well as which asset you should be buying. However, at this point we're using the free version of Passiv, and this means that while Passiv will give us this calculation, we have to go log into Questrade and make the trade ourselves. And that's a little bit of a pain. So if you do want Passiv to execute the trades for you, you can absolutely do that just by upgrading your account here. As we scroll down to target portfolio, you'll see that, of course, right now they're the exact same. We've got our target portfolio numbers in blue and our actual portfolio numbers in green. As you scroll down here, you'll find Edit Targets. So if at any point you want to change some of these numbers, you can do that here. And you can also remove an asset by clicking on the X. Any changes you make, remember to click Save, and then that'll be your new target portfolio. As you keep scrolling down the page, you'll see the current portfolio box. It tells you the number of units you have of each asset as well as its current price and value. And then in the last column you'll notice it says exclude, and that's another premium Passiv feature. And what it allows you to do is tell Passiv to exclude certain stock picks from your Passiv calculations. So for example, maybe you generally follow an index investing strategy using a couple of ETFs, but you like to have a couple of stocks on the side. And with Passiv Elite, you're able to do this. All you have to do is edit your targets, remove that specific asset from your target portfolio, and then at that point, the associated toggle bar won't be grayed out anymore, it'll be black, and you click that and that'll tell Passiv to exclude that asset. And then over here we've got settings. You can see it says buy only. And so Passiv is set to only calculate buy calculations by default. And that's because the more trades that you make, the more commission fees or trading fees you'll end up paying. So during your accumulation phase, during your working years as you're adding to your portfolio, you should be able to keep your portfolio on target just through these regular contributions. And so Passiv assumes that you're happy with keeping just buys, with just buying assets in your account. But if at any time you do want to sell, you can just hit the toggle bar here. And that's it for the main dashboard. We'll head over to settings now. You can see your Passiv credentials here, and you'll also see that we have cash notifications turned on. So if at any time you get new dividends or new deposits, you don't have to keep checking whether that new cash has arrived in your account. You'll just get an automatic email from Passiv, and you can turn that off here at any time if you'd like. And then here we can see our subscription and manage it. Right now we're on the free community edition, so the elite version does give you access to one-click trades. That's where Passiv makes trades for you. It also gives you access to that asset exclusion feature. And then finally, it gives you the ability to add additional Questrade connections to your account. So you can see down here, if I try to click add another connection, it'll tell us to upgrade. And so if you do manage, say, your partner's accounts or anyone else's, you can do that all from the one dashboard just by upgrading to Elite. And then once you're an elite member, you can go ahead and add them here. And then finally, I just want to draw your attention to these two columns here. We've got read and trade access to this initial connection that we've made. So read access means that Passiv is able to see the types of assets you've got and the number of units you've got, but it doesn't give Passiv trading access, so Passiv can't make trades for you. And if you do decide to upgrade to Elite, you'll want to turn this on. So to do that, just go here, click Trade, and then when you click Connect, you'll be taken back to Questrade's website to reauthorize that connection, and then Passiv will be able to execute trades for you. If at any point you want to delete a connection, you can do that here. And if you've ever got any questions, you can come over to Help, send us a message, or take a look at our frequently asked questions list. And then finally, when you're done, you can click Log Out. And I hope that walkthrough was helpful. Please let us know if you've got any questions. And so that was a walkthrough of Passiv. And as I mentioned in the video, there's a free version of Passiv, and what you can get in that version is Passiv will tell you the number of units you need to buy of which particular assets, and then you can go ahead into your Questrade account and make those trades yourself. And then if you'd like to either add additional Questrade connections, or if you'd like Passiv to make those one-click trades for you, then you can get the Elite membership, which is only $5 a month or $60 a year. And right now, Questrade has very generously agreed to subsidize it. So for the time being, it's only $40 a year. And that's all from my side. Let us know if you've got any questions for the two of us, and we'd be happy to answer them. Thanks.
Wonderful. Thank you, Anna, for that helpful walkthrough. And thank you, John, for the great presentation. There are some questions coming in from the audience. So if that's okay with you guys, I'll have a couple for both of you. So John, I wanted to start with you. Some great content around index investing generally. One of the questions that came up was around fees, specifically MER, management expense ratios, and an audience member asked, what does the MER include? What are you getting for that fee? Or do you have to pay additional commissions as well? Can you just speak to a little bit about, sort of what an MER encompasses?
Yeah, just make sure that I'm unmuted again. Can you hear me?
Yeah, perfect.
Perfect. Okay. So the MER includes the fees associated with running the fund. So if you're buying a mutual fund, it involves paying the manager of the fund. So whoever's purchasing those underlying investments then go to make up the fund. If it's an actively managed fund, it involves paying the manager to go and do the research and pick the stocks. If it's a passive fund, it involves paying the index provider to license the index methodology or the index components, basically, so they can go and make those purchases. And it also, if it's a fund that includes a commission to a salesperson who sold it to you, it includes that commission fee. When we're talking about exchange traded funds, because you're buying it yourself, there isn't that commission component, which means that the MER can be a lot lower. So it includes the fees of running the fund itself. If you're buying an ETF, then one other fee that you're going to have to pay on top of the MER is going to be the commission to buy it. Now, one of the wonderful reasons that I like Questrade is that for all ETFs in the North American markets, you can purchase ETFs commission free. And there's a little asterisk there because there's still what's called an ECN fee. So you'll pay a little bit of a fee, but not a full commission. And then you will pay a commission to sell your ETFs at Questrade. I hope that answers the question.
Perfect.
If there's still more,
that's great. Great answer. The next one, John, was just getting into a little bit more of specifics. It sounds like a lot of people have taken what you've said to heart and are kind of interested in learning more. So we had a couple of people ask about, is there anywhere, where would you go if you wanted to find, well-known Canadian and international equity funds? Like if someone wanted to start building an index portfolio, is there anywhere they can look?
Yeah, so it depends on how much you want to trust someone else versus doing your own research. So there are a number of people who put out model portfolios. So for instance, Dan Borlotti writes under the pen name of Canadian Couch Potato. If you go to his site, he's got some model portfolios up there that are extremely popular. I've got some up on my site and within my book. I think some other people, I'm trying to struggle to think of names. Oh, Justin Bender, that's the other one. He's got a model portfolio up. So you can go up and you can look at these people's model portfolios and basically copy them. Again, it's going to be up to you to make sure that it fits your individual circumstance and risk tolerance, because these are just general portfolios that we're all putting out there for the interest of education. But if you just want to trust that that general portfolio is going to work for you, then you can just start there. The other place to go is to research it yourself. And so then you want to start with looking at what kind of ETF are you looking for, which index do you want to track, and then find ETFs that then track that index. And you can look at the major ETF providers in Canada to find ones that fit you. So Vanguard Canada, if you go to their site, you'll see the whole list of their funds. They don't have too many. I mean, there's a couple dozen, but if you've got a Saturday afternoon and you just want to go through, you can look at each fund, look at each index that they track, what the differences between the different ones are, what their various MERs are, and you can see what Vanguard's offering. iShares, which is by BlackRock, is another big provider, and then BMO and RBC also provide index funds in the Canadian market, and there's a few other smaller ones. TD has a couple technically. Questrade has a couple of actively managed ETFs available. I think they're still available. And so you can go and look for these various providers, but the big ones in Canada are going to be Vanguard and iShares.
Great, perfect. No, that's very helpful. And then John, one more question for you before we switch to the passive questions. Someone asked about, so John, you talked about setting up, your asset allocation. Within those sort of asset allocations, within your equity bucket or within your fixed income bucket, for example, is there any sense or thought you have around switching ETFs based on performance or based on any other factor within that asset class? Or would your preference be to pick one fund within that asset class and then stick with it for the long term?
So my general advice would be to pick one fund and stick with it. That's going to lower your trading costs, and it's also going to make your life a lot easier because you're not going to have to constantly track this. There can be situations that come up where you might want to switch one fund for another. For instance, if a ETF provider comes out with a just substantially better fund that you want to switch to. So for example, a couple of providers recently came out with all-in-one funds. If you decided that instead of having a collection of funds, you'd rather pay the slightly higher fee to just have the extra convenience of having an all-in-one fund, then you can go and just buy that all-in-one fund and decide to switch. A couple of years ago, Vanguard had an international fund that had a particular ownership structure, which is where they, instead of owning the international equities directly, were owning a US listed ETF that held the international stocks. And then they introduced a new ETF that copied essentially the same index, but then was now owning the stocks individually, which was a better structure for Canadian investors in their accounts for very minor tax reasons. Then that might be a reason to switch. And again, when you're switching, particularly in a taxable account, you also have to consider that selling to switch is going to trigger capital gains considerations. In a TFSA or RSP, you're not going to have to worry about that. And then one more caveat is to make sure that if you're looking at your strategy, to stick with your strategy. So if you're focused on the larger cap portion of the index versus the total index, whichever one you decide to use to track a particular market, then make that decision for whatever reason and then stick to it. If your reason includes switching, then that's fine. That's your strategy. But if your reason includes that, I think over the long term, the TSX 60 will be better than TSX Composite because I like large caps, or the S&P 500 versus the total index. Whichever reason that you pick one, just try to stick to it, because odds are that if you're switching back and forth, you're probably going to get some of those switches wrong and end up losing money by trying to chase performance.
Perfect. That's great. Thank you, John. We coming up on time here, but we have time for a couple more questions. So Anna, I wanted to throw it over to you as we do have a number of questions about passive. There's some I was wondering if you'd just be able to speak a little bit more to maybe the origin story of passive and sort of where it came from. There seems to be some interest around how this product sort of came to life.
Yeah, for sure. So one of our co-founders, Brendan, he was an investor. He is an investor himself, and he wanted to basically automate what the robo-advisors would do for him. And he created his own script. He's a developer in his day job, and he started telling his friends about it, and his friends were really excited and asked him to make it available to them. And then he met the other co-founder, whose name is also Brendan. And I think there was some, shared sparks flew when they found out their names were the same. And the two of them started Passive together. And yeah, that's how it all came about.
Excellent. Perfect. Thank you. Yeah, no, it's a very organic story, and it's great to see how you guys have grown. So we have time for one more question here. And I don't know if you'll be able to answer this, but it's regarding multiple accounts. So if you were a user, as a customer, I want to, let's say, maintain an asset allocation across all of my accounts. But at Questrade, I have, a TFSA, for example, and an RSP, and then a margin account as well. Can Passive help at all in that capacity?
Yes. So for cross-account balancing, we're actually planning to release that in May. So by the end of the month, you'll be able to do that sort of cross-account balancing, whether you've got a TFSA, RSP, or any other kind of account. So that's coming soon.
Excellent. Perfect. And then just as a reminder here, for anyone that is interested, you can go to getpassive.com/Questrade to get started. And there is the free version that I believe is free for anyone to get started, right?
Yep, that's right. Yep.
Perfect. And then, as mentioned, we are running a promotion for Passive Elite. So for Questrade customers, it is only $40. So if you feel like that may be of interest, I encourage you to click through and check it out. So we are coming up on time now today, and just want to respect everyone's lunch hour. So we will wrap this up. John and Anna, thank you so much for the educational content today. It's very insightful and great to have your expertise available on the line. And thank you to everyone as well who attended. We appreciate you taking the time. We'll send out a recording later this week, likely Thursday or Friday. So keep an eye on your inbox for that. And that will conclude today's webinar. Thanks very much, everyone.
Thanks so much for having us.
Yeah, thank you.
Great. Perfect. Thanks all.
Thanks, everyone. Bye.
Bye.